while I think, we should have higher taxes, historically, when taxes are cut, growth actually goes up. And when taxes are raised, growth actually comes down because taxes and inflation both pull from us being able to spend and create production. It makes us spend less. And so if the government can't get us out of debt by spending money and taxing us, they allow more inflation.
You need to understand that, frankly, none of us really know what's going on. And why I bring that up is we just watched a video of Peter Zeihan talking about rates going higher and staying higher until 2035. We're talking a decade. So what I thought I would do is ask our good friend Anna Kelly to watch the video as well, so we can sort of talk about it, break it apart, and discuss if Peter is on to something. Anna, thank you so much. So you had a chance to watch the video?
I did. And just, I didn't have a chance to look it up because you just sent it to me. But it's Peter Zeihan, the guy that just wrote The End of the World is Just the Beginning.
Don't know, actually. It could be. We
I
could look
think
that up.
so. Let's look that up because that's an audiobook. Honestly, I didn't get to finish it, but I started it and it's pretty amazing.
Okay.
And I agree with a lot of his views. If that is it, The End of the World. It is Peter Zeihan.
Ah,
Okay.
there we go.
So
So
great
okay.
audiobook to listen to because it'll elaborate on a lot of his views. And I think he's got a lot of really good things to say in that book. And it gives me a better picture for why he said what he said in this last video. Okay.
Okay. All right.
Essentially his thesis, for those that haven't listened to him, his thesis in this video, which he didn't elaborate a whole lot in, but it's in the book, is that part of the post-COVID, so what? How are worlds reacting? How are nations reacting differently to COVID? And one of the big things is what you and I have talked about a little bit is reshoring and deglobalization.
Yep.
So since COVID, we really realized that this globalization, this globalized world, when things don't go well for whatever reason in other countries in which we rely for a lot of our imports, then that can be not only inflationary and cause all the kinds of things that it does now, but create bottlenecks, but it's also
Mm.
can become a national security issue. So when we add post-COVID supply issues, then we saw Russia go after Ukraine and all of the bottlenecks there were in wheat and oil and gas, et cetera, globally, although we were a little less impacted than some European countries. The United States government in particular, even under a Democratic Congress, generally speaking, and president, kind of started saying we need to start bringing things back to the United States, especially things that can become not only economic issues, but national security issues. So
For sure.
things like oil production, although, we still got the green energy stuff competing with that a little bit, but
Hmm.
microchips is a big one,
Yep.
semiconductors, and also a lot of what we need to create our prescription drugs actually comes from China. And so, in terms of drugs, microchips, semiconductors in particular, we're already working bipartisanly to bring back our own production here. Also, because of economic reasons, our country does not want us to continue to let other countries benefit from exports by overproduction. So we saw Janet Yellen go to China and say, quit producing so much so that you can send it to us cheap because we
Mm.
want to produce it here. And then yesterday or this morning, my hours kind of run together, we saw tariffs, new
Hmm.
tariffs on China. So basically all of these things, reshoring, tariffs, trying to bring things and bring production back here for both national security reasons and to create growth that we
Hmm.
otherwise don't have because we've been on a deflationary demographic path. Essentially, all of that has a cost to it. So
Sure.
Peter Zeihan's, main thesis, which you and I talked about before I even started reading his book, was that as these things happen, it has a cost to it. The government has to spend a lot of money to create all of these things. And then we have to also look at spending more money for the energy grid and, highways. And part of the Build Back Better plan is let's bring things back here, make America dominant in production again. And the government spending money to produce all these things creates jobs, creates higher wages. And in fact, there's tax incentives as part of the Build Back Better plan to pay higher prevailing wages and do everything in an energy efficient way. That's going to put money into the system, which causes inflation. So he thinks, hey, inflation's here because of the government and because of, wars and COVID and all of that. But the government continues to spend money that's propping up the economy. It's needed, and it's going to make inflation hotter and growth hotter than what we've seen. And therefore rates are going to be high. So that's the thesis. I agree with him on a long-term basis. I disagree with him on a short-term basis. So he says, get used to rates where they are now. There's no way the Fed is cutting rates. Where they are now is where they're going to be for the next decade. I think, and then I'll open it up for back and forth, and I'm sorry for this kind of long-winded intro to where he is, but I think that in the short term, we are having a recession. I believe we're already in it. Again, you and I have talked about, I thought we were in it before. The NBER has not yet declared it, but we have so many signs of slowing growth and recession. Most of our GDP, as low as it is, has been produced by government spending. And I think that we're going to have a recession that's going to cause the Fed to have to cut rates. It's going to cause both the Fed and the US government to stimulate with QE to get us out of the recession. It's going to be a small window of opportunity. Average recession lasts 10 to 18 months with a 2 to 3 year recovery rate. Once we're in enough of a recovery, it's back to what Peter's on is saying, higher spending, higher inflation over the long term. So long term, I agree with him. Short term, I think he's missing the recessionary conditions that are going to cause the Fed to have to pivot, have to cut rates, and go back to QE for a while.
Yeah, because I need to go check out that book. I'll put the link in the show notes below. I did not know that was his book, so I have no context. So thank you for that. I would agree. We're on a structural path to higher inflation. The more and more we onshore, it's just you pay a U.S. citizen more than you pay a Chinese citizen to make stuff. It's fact, right? Even if we have more automation, right? It's inflationary. So I think structurally, we are on for some inflation, right? Chip factories and PPE or personal whatever protection, all that stuff, drugs. So I get that. When I listen to Peter, I've listened to that now 3 times because I knew you and I were going to speak. The thing that I thought he was missing a couple of things, because again, I think he could be right if you look at decades, but when you kind of step in and look a little bit more micro, I just think it's unlikely we don't have a recession or some kind of black swan. I mean, it's just we've already been on this run. I mean, it's like logic. Could we go another 10 years without a recession? I'm like, I don't think so. I can't wrap my head around that.
Right.
So I think that's highly unlikely. I think the other thing that was completely missed in this 8-minute speech, again, he may have covered it elsewhere, is the fact that Jerome Powell's term is up in April or May. So let's just pretend for a moment that Jerome Powell has the cojones not to cut until his term is up, which I believe he does. I believe that's possible, that he doesn't cut until May. But okay, we're into next year.
May of next year.
Right, 25.
Right.
So we go another 12 months. Powell sticks to his guns. The president, either left or right, doesn't beat him up. He sticks to his guns. I believe that's possible. Okay, he's out. Now you're the president of the United States, either one, and you get to pick or nominate the next one. Do you think you're going to pick a Paul Volcker who's going to, give you the middle finger and not be swayed? Or are you going to pick a puppet? I think you're picking a puppet, hands down. And if you pick a puppet, you're going to get your rate cuts. I think that was also missed. What do you think of all that rambling?
Yeah. I think there's a lot of things, and as we've gone through this, right, the older we get and the more we go through, we realize how little we still know,
Yeah.
right? So we can know a lot, but there's what I've realized, and I realized it after the GFC, and I realized it after COVID, and I'm realizing it even more so now, is that the economy is not nearly as simple and easy to define, easy to understand, and easy to regulate if you're the
Mhm.
Fed as it was, in previous decades. And we learned that through the GFC, right? We look back and we say, how could the Fed and Congress, and the president, have missed all of these mortgage-backed securities and the fact that they were being hedged, and credit default swaps, and collateral loan obligations, and basically all the derivatives market, which is actually much, much larger now. It's somewhere between
Yeah.
a quadrillion and $4 quadrillion of unregulated shadow banking contracts. Okay.
Yuck.
So we don't even talk about the risk of all of that falling again, although the risk is really there. But what my point, Michael, is that things are really complicated. And when you add these black swan events, COVID, and then Russia, Ukraine, and Hamas, Iran against Israel, and they're all happening at one time.
Mhm.
There are so many things that get broken in that process. We look at the headlines of war and death and sickness, but there are supply chain issues. There are currency wars and trade wars that result, which not a lot of people talk about. You want another really good read, Michael, and maybe we can talk about this in detail on a future show. I'm not an expert at this, but it's called Global Shocks, I believe it
Okay.
is. And it's about when you have global issues, oftentimes governments don't do what they necessarily wish they could do for their local economy because of currency wars and trade wars that result, and oil and energy battle for
Mhm.
dominance. And so, you know, all of those things are things we're not even talking about in the midst of, where's CPI going, and where is growth, and what does that do for recession, and then what does that do for future growth. If we just talk about the US, we can talk pretty intelligently that if history repeats itself, okay, you and I both believe we're heading toward more recessionary conditions,
Mhm.
and we see all these other things created by global shocks that could be very inflationary in the future. But the what we don't know, and why it's so hard to predict, is how is the Fed going to react? What is the US federal government going to do in terms of fiscal spending? How does that impact inflation, which we know, and you and I can, banter on that
Mhm.
part pretty easily. But then what is the reaction to tariffs by China? What happens to global growth, and how does that pull on
Mhm.
US growth? What happens if there's another war, if China goes after Taiwan, if there's another pandemic? All bets are off. So when these things happen that we don't expect, let's talk about the US banking system and how
Mhm.
fragile it is, and how we are very close to another banking crisis. It hasn't happened yet. The Fed recognizes and is working on backstopping if it happens. But all of these things are so complicated that I find it difficult for myself, even though I have a pretty good broad understanding of how these things should impact growth and inflation. Um, I can't wrap my head around and say I have confidence that in the next year or 5 years or 10 years, here's exactly what there's going to be. The only thing I have confidence in is that we're in a pickle, to put it mildly. Your I forget what it's called, onomatopoeia. Peter picked up peck of pickled peppers or something like that, like you had at the beginning of this talk. But it's complicated, and
Yeah.
I think that we are in for a decade of, if we're lucky, stagflation.
Wow.
When you take all of these things together, there is not much. You talk about inflation. Inflation requires a strong consumer and money supply to increase. So Government can create inflation by spending more, which I think they're going to do. And I think that that's where most of the inflation is going to come from. When we talk about demographics, we're still on a deflationary path, Michael. The question is, structurally, do we change from deflation to inflation? I don't think we have enough population to create that structural change unless we have the miracle AI productivity growth, the miracle Build Back Better productivity growth. It would require significant immigration to increase more people. And we've started to see that. That's become a real political issue. But when your population gets below a 2.1, I think it is, replacement rate, it could be 2.4, somewhere like that. It's over 2. Economies die, countries die. And we're already below that number for replenishing the number of people working to pay for the benefits of the people in the past. And so we are on a demographically deflationary path in terms of production. And therefore, the government has to spend to create enough production that gets our GDP above inflation. And I think that's going to be very difficult to do over the next decade, although we're going to try, without big changes. So unless we can create sufficient growth to be above inflation, which we know is going to be higher, then over the next decade, that's pretty flat. You've got some sectors of the economy inflationary, some that are really struggling, government spending that is out of control, and there's not a lot of hope for them cutting costs, potential increases in taxes to cover that government spending. And what does that do, Michael? It pulls growth further down. And historically, regardless of what which political aisle you're on, I've done some study on tax increases. And while I think, we should have higher taxes, historically, when taxes are cut, growth actually goes up. And when taxes are raised, growth actually comes down, because taxes and inflation both pull from us being able to spend and create production. It makes us spend less. And so if the government can't get us out of debt by spending money and taxing us, they allow more inflation. And to Peter Zeihan's point, they want more inflation to make the cost of our debt easier to pay off with future dollars. It makes it seem like today's debt is small compared to where money will be in the future. And that, again, is very inflationary to the dollar, at the same time that demographics is pulling growth down, naturally deflationary. Where we land, I don't know, Michael, but I don't think it's strong inflation because growth is going to be pulled down. I don't think it's strong growth because of demographics. So I think we have something more akin to stagflation than we've seen in my adult lifetime, because we have these warring inflationary factors at the same time that demographics and growth is slowing. And there doesn't seem to be this productivity miracle that we're hoping for to keep growth above inflation.
Yeah, then the last thing kind of on this, Peter Zeihan talk that I was rattling around in my head is like, okay, if rates stay here or go higher for years, in my mind, that just breaks commercial real estate, right? We're seeing,
Sure.
trillions of dollars kind of extend and pretend. And, if you go out till 2030 at these rates, we have a banking crisis. I mean,
100%.
I don't know how else to look at that, right?
100%. And people, the news media and economists are really downplaying the risk of that. Yellen goes out and says the banking system's strong and we have backstops if there is a commercial real estate. They're acting like office is the only one hit. Office is hit because of COVID, but the fact that all commercial real estate, and I'm saying 5-unit plus, true commercial real estate,
right, 5 and above, yep,
is basically variable rate debt at some point. So even with the exceptions to that is multifamily Fannie and Freddie loans, we can get 10-year loans on a 30-year AM at a fixed rate. But other than that, most real estate debt is variable, meaning that after your initial 2 to 5 year lock-in, your rate changes every single year. And so
yeah.
Already we've had an increase this year, and last year was we had a lot of foreclosures in commercial. This year it's up 121%, 117, 121, depending on the article that you read. But there is $1 trillion more of debt that has to be rolled over this year. Out of 2 trillion last year, about 1 trillion has been recast and extended one more year. I just read that through Arbor, an article that came out in the last couple of days. And so, we have basically a year. We're going to see a lot more foreclosures, but essentially, not only is it rates, and this is what people don't understand, but not only are developers and commercial real estate owners dealing with their debt service cost increasing, but when they have to go to have their loan reevaluated, because what people don't realize too is it's not like a residential mortgage, you get it for 30 years and you never have to report to the bank. I have to report financials on my multifamily assets every quarter to every year, depending on the loan, whether it's small balance or large balance. And that's with the federally backed lenders. And so when they look at your loan, they're going to say, hey, we know your rate is resetting, your debt service is going up. Let's look at the new loan to value and your current debt service. And if your LTV and your debt coverage ratio are not in line with where they were when you purchased, it is called a cash in refi. You have
cash
to pay in.
Yeah.
And in many cases, it could be $10-20 million that you have to pay in to keep your loan. And if you can't, you hand back the keys. And the issue with the banks is that, especially regional banks, there are currently almost 300 out of 4,000 banks that are on the cusp of failure right now.
I saw that.
According to economists who track, there's an economist I really like, his name is Rebel Cole, and he is a finance major. He's worked for the IMF, and he's tracking the health of all the banks because he was a bank regulator who knows how they determine bank health and whether they're going to fall. And that's just the beginning. So as soon as, if rates stay higher for longer, these banks cannot keep these loans on their hold to maturity balance sheet like they did bonds. They have to mark them available for sale, mark to market. So all of a sudden their asset, which is our commercial real estate loans, the bank's assets are written down. If the assets are below their liabilities, which in many cases they are, and if their borrowers continue to flee the bank, their depositors flee the bank for higher money market accounts, for example, or buying treasury bonds, then their depositors flee, further reducing their assets. And so this can lead to a bank failure. And if anyone doesn't believe that, Tom Honig, who was a Fed governor, I believe Kansas City Fed, was a voting member of the FOMC, but he also was the president of the FDIC, Federally Deposit Insurance Corporation, that backs all of our bank deposits. He says it's a hurricane, that if it was a 4 out of, you're rating it, we're at a 4 out of 5, category 4 hurricane, really close to a 5 being a true banking crisis like we saw through the savings and loan crisis. Now, the Fed will probably backstop it much more quickly, try to sell all these banks, consolidate banks into bigger banks like JP Morgan Chase, et cetera, try to find buyers for it. But if you have a banking crisis and another global financial crisis, you can bet, Michael, that there are significant layoffs, very high unemployment, all the people employed through all of these different banks, people fearing deposits, being taken or not being, FDIC doesn't have enough to cover all of these deposits. And that will suppress growth significantly, put us into a deep recession, potentially a depression or another global financial crisis. And that leaves rates really low for a while as the Fed tries to get us out of that and create stimulus again and go back to QE. And then the government has massive debt to fix it. And then it's inflationary, just like Peter Zeihan talks about. So I think the biggest disconnect for us and Peter Zeihan is not recognizing the real risk that we have, not only recession and deep recession, but potentially if the Fed makes a policy mistake by keeping rates higher or even trying to raise them, which I don't think is going to happen. But if they did that, your biggest risk is that you completely ruin the financial system and you have another 2008 type of, financial crisis on your hand. That's much worse than them letting a recession happen,
Mm.
and starting to cut rates slightly and deal with inflation a little bit at the same time.
Yeah, that's where I kind of come to. When I play this out, if rates just stay where they are for 3 years, the commercial banks break. They break,
For sure.
right? 292 banks already on the list. The list probably doubles because again, regional banks, 3, 4, 5 branches are all over indexed in their community and probably on asset types.
Yeah.
And
And who do we borrow from, Michael? Even small commercial properties. It's generally your local mom and
yeah,
pop bank. So if
exactly.
local mom and pop banks start to fail, and you need to go to a bigger bank for
Yeah,
starting a new business or refinancing your loans or buying real estate, it's very depressionary on local markets. And so I
yeah.
think it's a real, the Fed knows this. The question is, are they underestimating how fragile the banks are? They had oversight and still didn't see coming, the interest rate risk that brought 3, 4 banks, down
Right.
now that are pretty large. And so, you know, I think the Fed is making policy mistakes. I think that they are looking at inflation without giving equal balance to the already recessionary conditions we have that are going to allow inflation naturally to come down if
Mm.
the government doesn't really increase spending. And that's really the question is, do we have fiscal dominance, which is where the Congress is overspending and creating more inflation because every dollar that they spend, even on interest payments, goes into someone else's hands, Michael. So people are saying, well, why is that inflationary? Well, if they're paying over $1 trillion on their bonds, who are they paying it to? Retirement funds, you and I, other investors. And so that money increases your savings and it increases those that have their ability to spend. Those that have not, it crushes. And so it creates more
Yeah.
wealth gaps. But, the Fed is losing control of rates to some extent because of fiscal dominance and government spending that has kept inflation a little bit higher. Meanwhile, the consumer is absolutely raw. Highest credit card delinquencies since 2011 post GFC. Highest, there's over $1 trillion in new credit card spending over the last several months. I mean, it's crazy. Households don't have any savings left. They're spending less, even retail sales, Michael. Units spent are down. They're just spending enough to survive. And more than 80% of consumer spending is on housing, healthcare, and insurance. So,
Mm.
you look at just those three things, they're not spending on services and things that are creating real growth. They're spending just to survive. So I think we've got some real challenges with the Fed. I'm hoping that they actually start cutting rates as the economy slows and as CPI starts to come down naturally because growth is coming down because the consumer just can't spend anymore and they are 70% of CPI.
Hmm.
But if you've got a consumer that's falling while the government is spending, you're going to have inflation at the same time you have low growth, and that's like classic stagflation. So the best case scenario from my perspective, Michael, is we have a recession, the Fed allows it, and they start cutting rates into it to keep us from going into a much deeper financial crisis by keeping rates higher and breaking the banking system.
Yeah. A lot of fun stuff. We're going to talk about inflation in the next episode, but Anna, how can someone follow you?
Great. You can find me here on my playlist on your channel every week. You can find me on social media at Anna Kelly REI Mom. And if you're looking for real estate, wealth coaching and consulting or investing, AnnaKellyInvesting.com.
Awesome. Thank you so much.